Okay, let's just get right into it. If you've been looking at the markets lately, I'm going to guess you're feeling pretty anxious, right? I mean, it can feel like all your hard-earned gains are just vanishing in a couple of hours, and it's totally normal to be worried. But today, we're going to talk about what's really going on, and more importantly, why history tells us that making a sudden move right now could be the biggest mistake you can make.
So this is the million-dollar question, isn't it? When your entire portfolio is blinking red and every news channel is screaming about a crash, what's the smart move? Well, the answer is actually surprisingly simple. But before we get to that, we need to understand what got us here in the first place.
You know, this whole downturn didn't just pop up out of nowhere. It all got kicked off by a sudden flare-up of tensions over in the Middle East, specifically around the Strait of Hormuz. And frankly, it caught the whole world economy flat-footed. And the immediate domino effect was huge. The conflict basically led to a blockade of the Strait of Hormuz, this tiny little waterway that is absolutely vital for global trade. I mean, think about this. A full 20% of the entire planet's oil supply flows through that one little choke point. So when it got shut down, you could practically hear the markets holding their breath. So with that much oil suddenly off the table, prices for everything just went through the roof. At first, maybe investors thought, okay, this will blow over. But as the situation got worse, the market started to bake in the idea that this wasn't going to be a quick fix, and that is when the real panic set in. Now, it's so easy to feel like, wow, this time it's different. This is the big one. But here's the thing. It's really not. Let's zoom out for a second and look at the big picture. Because history shows us this super clear and honestly kind of optimistic pattern. Every single crash has always been followed by recovery.
I mean, just look back. We've seen this movie before, right? The Great Depression in 1929, the dot-com bubble in 2001, the Great Recession in 2008. These huge downturns, as painful as they are just a regular part of the economic landscape. They're a feature, not a bug. And the most important part isn't the crash itself, it's what always happens next.
Think about the absolute devastation of the Great Depression and World War II. I mean, you can't imagine a worse time to invest. And yet, in the 14 years that followed that period, the market didn't just bounce back. It exploded, with average gains of over 815%. And that wasn't just a one-off. After a small dip right after the war, the pattern repeated itself. The next 15 years, an incredible 935% gain in stocks. It just shows the massive potential for growth that's waiting on the other side of these crises.
Okay, let's jump forward to the 1970s. You had runaway inflation, massive economic uncertainty. Sound familiar? The market lost a gut-wrenching 40% of its value. But for the people who just held on, the next 3 years delivered average gains of 845%.
Or what about Black Monday in 1987? The market fell 22% in a single day. People were freaking out. But the rebound, just as epic. Over the next 13 years, the market climbed over 800%.
And we don't even have to look that far back. Remember that super sharp COVID crash in early 2020? The world felt like it was ending. The market fell off a cliff, but it recovered just as fast, jumping 120% over the next few years. The pattern just keeps holding up again and again.
So here's the whole story in one simple chart. If you look at the last 100 years and you just count the good years versus the bad years, it's not even close. Yeah, the losing years happen, and believe me, they hurt, but they are totally outnumbered by the profitable ones. Panicking and selling during a bad year just means you're almost guaranteed to miss out on all the growth that history shows is coming right after.
So, if history is so clear that markets always recover, why do so many people end up losing money? Well, the answer isn't in the stock charts, it's in our own heads. The single biggest threat to your portfolio isn't a market crash, it's your own brain during a panic.
And this right here, this is how investors constantly shoot themselves in the foot. It's a classic cycle. It starts with excitement and FOMO, right? You buy in when prices are high. Then the market drops, and that excitement turns into pure panic. So what do? You sell near the bottom, turning a temporary paper loss into a very real, permanent loss. And then you have to sit on the sidelines and just watch and regret as the market recovers without you, only to finally buy back in at the same high price you started at. It's a cycle driven purely by emotion, not by logic.
So, how do you stop this vicious cycle? Well, the answer is incredibly simple. There is one tried and true method that has worked through every single crash we've just talked about. It's called a long-term buy and hold strategy.
But here's the key. To actually do this, you need more than just a strong stomach. You need a completely different way of looking at things. It's all about building a new mindset that totally reframes a market crash from a moment of terror into a moment of genuine opportunity.
Let me put it this way. Imagine you buy a brand new TV you've wanted for ages. A week later, you walk by the store and see that same TV is now on sale for 20% off. Would you panic? No. You'd probably be kind of annoyed you missed the sale, or maybe you'd even be tempted to buy another one. That's the long-term mindset. A market drop isn't a signal that everything is worthless. It's a sign that your favorite investments are on sale.
And that mindset is really the heart of the whole strategy. Buying and holding is all about having the courage to stick with your plan for the long haul, not in spite of the market going up and down, but because you know it will. It means you have to learn to ignore all the scary short-term noise and just focus on that incredibly powerful long-term pattern of growth we saw earlier. Okay, so what's the actual game plan? It really just boils down to these 3 simple things. Number 1, stay employed. Your income is your best wealth-building tool, period. 2, keep investing consistently. Don't stop. Whether the market is up or down, just keep putting money in regularly. And 3, think long-term. And I'm not talking about next year. I'm talking 20 years, 30 years from now.
So if you take away only one thing from this, let it be this. The market is going to go up and the market is going to go down. You have zero control over that. What you do control is how you react. The biggest financial risk you're facing right now isn't the falling market. It's giving in to that fear, panic selling everything, and derailing your entire long-term plan. You know, Warren Buffett has this famous quote that just sums it all up perfectly. A market crash is the time when fear is at its absolute peak. And according to one of the greatest investors who ever lived, that is the exact moment of greatest opportunity. So the only question you have to ask yourself now is, are you ready to be just a little bit greedy while everyone else is so afraid?